Dividend stocks are an amazing way to build up passive income streams, but in order to do so in an efficient manner, you have to do your research to make sure that your principal investment is not going to depreciate over time. Welcome back to my channel, Physician Finances and Investing. I'm Joe, a resident physician, and in my last video, we talked about some important dates that all dividend investors need to know. In today's video, we'll be continuing the dividend series and discussing some important metrics that I and all dividend investors need to pay attention to before making that initial investment. So with all of that being said, you guys know what time it is. Let's talk about how to get that bread. What's up, YouTube? Welcome back to my channel, Physician Finances and Investing. In today's video, we're going to be discussing how to find some high-quality dividend investments. I'll be discussing some of the metrics that I like to use whenever I'm evaluating different dividends before making the initial investment. This video will not focus on evaluating the specific stock, the company's balance sheet, or the specific sector. I'll save those topics for future videos. But in this video, we will be discussing how to evaluate the dividend and how to determine if it's a quality dividend and a safe long-term investment. The first metric that I like to look at whenever evaluating different dividend stocks is called the dividend yield. For those of you who may not be familiar with this term, the dividend yield is calculated by taking the amount of the yearly dividend and dividing it by the stock price. So for example, if a company is paying $5 per year in dividends, and a share of the company is currently trading for $100 per share, then the dividend yield would be 5%. In my opinion, when evaluating different dividend-paying stocks, I like to see a dividend yield of at least 4%. Now, this is not a hard and fast rule because you also have to take into consideration the potential appreciation of the stock price. For example, would I immediately ignore a growth company like Apple because I see that it's paying less than a 1% yearly dividend yield? Heck no! I also consider the potential stock price appreciation and the fact that growth companies like Apple are likely going to continue to increase their dividend payments each year. But for companies that are more of a value investment, meaning that they're not going to be seeing a huge year-over-year growth in their revenue and in turn growth in their stock price, I like to see at least a 4% dividend yield. Examples of value stocks would be things like Coca-Cola and Johnson & Johnson. But if the dividend yield is too high, then it may be too good to be true. And that's where the second metric, the dividend payout ratio, comes into play. By definition, the dividend payout ratio is calculated by taking the dividends paid per share and dividing it by the earnings per share. So it's basically a quick and dirty way to evaluate how much money the company has available to pay its yearly dividends. Personally, I like to see a dividend payout ratio of 70% or less. If the dividend payout ratio is too high, then that means that the company has limited ability to grow their dividends year over year. Or even worse, if we find ourselves in a bad economic climate, like we currently are because of the pandemic, then you may see companies decrease their dividend or suspend the payment altogether. Depending on the type of stock, such as a real estate investment trust, more commonly referred to as REITs, you may see a dividend payout ratio greater than 100%. And it's more acceptable in those situations because for investments like real estate, you have to evaluate them in a different way. But in general, I like to see a dividend payout ratio of less than 70%. Now you might be asking yourself, is there such a thing as too low of a dividend payout ratio? No, not really. That just means that the dividend should be sustainable for years to come and also that there's room for the company to grow that dividend in the future. But then on the contrary, is there such a thing as too high of a dividend payout ratio? Yeah, there definitely is. You may see some companies with a dividend payout ratio greater than 100%. That means that the company doesn't have enough revenue to cover the cost of their dividend. Or it may even mean that the company's actually taking on debt in order to pay out the dividends to its shareholders. This could be a sign that inevitably in the future, at some point in time, the dividend is going to be cut. The third thing that I like to look at is the 10-year growth rate. As you guys know, I'm a long-term investor. So ultimately, I need to know that my dividend income is going to be able to keep up with inflation. So I like to see a 10-year dividend growth rate of at least 6 to 8%. If it's lower than that, then I'm fearful that my investment isn't going to be able to keep up with the cost of inflation. But what if the 10-year dividend growth rate is higher than that? That in and of itself isn't necessarily a problem, but you do need to be careful and take a look at those metrics that we just previously discussed, because if it's too high, then that may be a signal that the company isn't going to be able to maintain that for the long term. The last metric that I like to look at when evaluating a dividend is the 5-year to 10-year ratio, which basically is looking at how the company has been able to grow its dividend over the previous 5 years and compare that to its growth over the previous 10 years. Ideally, I would like to see the 5-year to 10-year ratio greater than 1. But if it's approximately 1, that's not a problem. It just means that the dividend growth rate is stable. If this ratio is too low, then that means that the dividend is not growing nearly as fast as it once was, and it makes me question if my investment is going to be able to keep up with inflation. But again, if this ratio is too high, that in and of itself is not a problem as long as the company is able to afford to continue to pay out this dividend, and that's where things like the dividend payout ratio come into play. When it comes to evaluating the dividend in and of itself, those are the main metrics that I like to look at. But before I pull the trigger and decide to put money into a particular investment, there's a lot more that I want to know about the company. And that's where things like looking at the balance sheet and listening to the conference calls come into play. I'll be sure to talk about all of that in a future video if you guys are interested. With all of that being said, I want to end this video by leaving you guys with an example. Let's say that you have 3 stocks: stock A, stock B, and stock C. Let's say that stock A has a dividend yield of 2.5%, a dividend payout ratio of 43%, a 10-year dividend growth rate of 13%, and a 5 to 10-year ratio of 1.1. Stock B has a dividend yield of 4%, a payout ratio of 43%, a 10-year dividend growth rate of 3.4%, and a 5 to 10-year ratio of 1.4. And last but not least, stock C has a dividend yield of 10%, a dividend payout ratio of 118%, a 10-year dividend growth rate of 36%, and a 5 to 10-year ratio of 0.3. Which stock would you be most likely to invest in, and which one would be least likely? Comment below and let me know how you would rank these stocks and why. As a reminder, I'm not a certified financial planner. I'm a resident physician who recognizes the importance of taking an active role whenever it comes to managing your finances and wanted to encourage others to do the same. With that being said, I highly encourage everyone to do their own research before making any financial decisions. That concludes another episode of Physician, Finances, and Investing. I hope that you found this video both fun and informative. If you have any questions or would like me to discuss a particular topic in a future video, please feel free to comment below and I'll be sure to get that information to you guys. And if you haven't already, please smash that like button and click on the subscribe button to let me know that you like what we're doing here at Physician, Finances, and Investing and to help support my channel. Thanks everyone, and have a great day.